Doing some more back testing. We got for you today some symmetric risk reward analysis in trending US dollar pairs. What does that mean, Mike? It's a catchy name that I came up with that hopefully has a lot of buzzwords in it. But we have some historic context for this, as we called out a slight dollar comeback on the table, not nearly to the magnitude that a dollar recovery would need to get back to even where we started the year, let alone the past 2 years of dollar strength. But it was interesting to me to see, the U.S. dollar yesterday posting 3 successive days of gains against a lot of major currencies. Here we're looking at the U.S. dollar Canadian dollar pair, which is bouncing off of its lows from 136 towards 137. And when you really zoom in to FX markets, most traders that aren't involved in FX spaces might just be in the background, knowing that the dollar's weakening on tariff news. But if you are getting granular and you're trading in these markets every week, every day, there has been two-way price action. And we wanted to look into how you can identify moving markets. And when you do contrarian or momentum strategies work best? Like if you see this 3-day up move, would over historical examples, would trying to fade that little move work better than trying to capitalize on perhaps a trend of further dollar strength? So what we did was we used the past 6 years of price data using high-low, open-close daily data for the major US dollar pairs, 7 for you here: Euro, Pound, Yen, Australian dollar, Canadian dollar, Swiss franc, and New Zealand dollar. And we used that 3 consecutive up or down day example as criteria for trade entry. So we simulated trades that only occurred after examining or observing 3 consecutive days in the same direction, and tested both if you were to put on a momentum play there, betting on continued performance, a 4th consecutive up day as an example, or putting on simulating a trade where you're fading that move. And so what we did is we used symmetric risk reward price targets, so getting stopped out if you hit your percentage price target or if that move went against you into the same magnitude, and used a 5-day max holding period. This is something we played around with, doing 5 days, 10 days, but really wanted to see, you don't want to be stuck in a pair if you're trading this frequently for more than, say, a trading week. And so use this 5-day max to try and determine, how does symmetric risk reward performance fare, and what kind of profit targets should we expect with this max holding period, and calculated win rate, a ton of performance metrics for you. So don't want to waste any more time getting into it. First, we looked at 1% price targets. So if a move from your trade entry went an additional percent in your favor or against your favor, and here looking at momentum plays, we got a lot of data here, but we got win rate, average P&L, average days held, the percentage of when your profit target was hit, loss target was hit, and time stop was hit. So all of these are really important, but what stands out to me off the jump is the US dollar, Japanese yen as the only real winner here for momentum plays, using these constraints, with the only one with a win rate over 50%, only one with positive average P&L. But what's also interesting to me is the next conclusion I draw from this is that time stop hit is really getting dinged a lot here, Mike. You're getting in this US dollar, Canadian dollar, you're getting stopped out due to time over 60% of the time. And so to me, that spells out that if you are looking for just trading within 5 days, already I can see that this 1% price target or stop loss is a little bit wide because you're getting stopped off due to time a lot more frequently than not. Is there anything else you see from this table here?
Sure. Yeah. Again, past performance is not indicative of future results, but this kind of shows markets are pretty efficient, right? Mm-hmm. In some sort of sense, because when news drops, markets are repricing things based on the variables changing. It just goes to show you kind of how efficient they are with that full move being priced in immediately, right? And then the market doesn't really care about that after. Again,
even over 3 days.
Yeah. Which is kind of interesting. Yeah. Again, not always right in this scenario, because then another headline comes out, another piece of data comes out, or something crazy changes, right? So again, it's always different for every single scenario, but it's just interesting how fast things move, and then it doesn't really matter anymore. It's kind of what these numbers show me, just with the stop loss target hit plus the time stop being hit when you combine both those.
Agreed, but even though it is close to 50-50, when you pull up the contrarian example, very similar table here, you are seeing, aside from this dollar-yen, a slight edge here, even with 1% profit targets of mean reversion, contrarian plays after 3 consecutive up or down moves. You're still getting stopped out due to time, a majority of the time, but even though you're not at that full 1% band in either direction, tends to play out historically in the contrarian's favor, and this British pound US dollar emerging as the winner here with an average P&L of 0.1%, which, you know, if you're a stock trader, it might not look like anything at all. Why are we even talking about this? When you're trading on leverage, then that can be a pretty substantial P&L for you, and could even be a sustainable strategy long term for you. And so aside from that pair outperforming, again, just hammering home that for these 1% profit targets, seemed to me that it was perhaps too wide, because you're getting stopped out if you want to trade within 5 days. So what we did next, we took it a little tighter, 0.5% price targets. And this, you know, it all depends on your P&L is actually based on your per pip movement, but using percentages here was a way to kind of level the playing field with all of these different dollar pairs. And this 0.5% level is typically what we see more often with the daily kind of range, daily 1 standard deviation move that we talk about on here quite frequently. And here in the momentum category, we're seeing a similar story for dollar-yen, but also seeing this New Zealand dollar coming out and outperforming for momentum strategies, because here when I'm looking at, I'm not looking necessarily at the win rate, but you're looking at the time stop hit and the profit target hit. And here you're seeing 54% of the time with these constraints, New Zealand dollar momentum plays is hitting that price target, and only 1% are you leaving it, you know, just closing it due to time. And so in my mind, that is the outperformer from this table. But again, momentum not doing as well as contrarian plays, and this makes sense to your thesis of kind of efficient pricing and, you know, moves that are perhaps overextended without any sort of categorical fundamental changes like we've seen the dollar slide so much this year. Without that, those outsized moves, we tend to see contrarian plays perform a little better, getting a slight edge. But man, here you're seeing across the board win rates of above 50%, except for that dollar franc. And you're seeing that pound dollar and also that Australian dollar emerge as winners here, with nearly 55% frequency of profit target hits, and again those time stops really low. So in pound dollar and Australian dollar, over 5 days and using a 0.5% price profit bands, you're not going to get stopped over 5 days due to time, more than likely, but you're still seeing those average day held. Those are the shortest as well, at under 2 days. So a lot of interesting little tidbits here to derive. Not necessarily that this is an end-all, be-all strategy analysis, but I think a good starting point for trying to understand what to consider, what price targets are reasonable to assume over what time periods here. And so going to the key takeaways is, symmetric risk reward, you're tending to see over this short-term interval close to 50-50. 1 week trading periods, we're seeing mean reversion strategies have a slight edge, but slight edge is everything, when you're playing a 50-50 game. And the outperformers here across the board, British pound for contrarian and dollar yen for momentum. And then those have seen a lot more success getting dinged on your price targets with 0.5% bands than 1%. Now you could play with, the actual time period. Perhaps if you live for 10 days, then 1% is absolutely in play, but over 5 days. And what was surprising to me is that even with those tight ranges, trades taking more than a day on average. Any other key takeaways for you, Mike?
It's pretty interesting. If you want to go to that last 0.5% profit target contrarian slide, that one here, and just goes to show you how correlated Aussie and Kiwi are, right? NZD, USD, I should say. And again, not exactly right here, but Kiwi is kind of like a more high beta Aussie, right? It kind of moves more. And then when you're looking at it from either the contrarian or the momentum perspective, it just goes to show you not only is that move more, but the kind of the momentum and the contrarian side is also exaggerated in those scenarios too, just based off average days held, right? Profit target hit, or that time stop hit too. You just see the exaggeration relationship between the two on there. So that kind of cool to see just in the data itself.
Agreed. And that'll do it for us with this study. Hope that got your gears turning a little bit.